Today's the 27th of February, 2026, and silver is sitting right around $87 to $90 per ounce, depending on what time you check your screen. Let that price settle in your mind for a moment, because exactly 4 weeks ago, on January 29th, this same metal was trading at $121 per ounce, an all-time record high. That means in the span of a single month, silver lost roughly 30% of its value. And yet, while that crash was happening, physical silver dealers in Britain were posting out-of-stock notices. Mints were reporting 2 to 3 week delays just getting metal from refiners. Indian mutual fund houses, including SBI Mutual Fund, Kotak Mutual Fund, and UTI Mutual Fund, had halted new subscriptions entirely because they could not source enough physical silver to back the units. Price going down, but metal impossible to find. That is the contradiction sitting at the center of this market right now, and it deserves a proper explanation. Let's go back to where this all started, because the January blow-off did not come from nowhere. Silver began 2026 in structural deficit for the 5th consecutive year. According to the Silver Institute, global silver consumption has exceeded global mine production every single year since 2021. That matters because silver is not primarily a financial asset. Roughly 60% of annual silver demand comes from industry. Solar panels alone consumed 232 million ounces in 2024, up fivefold from 2015. Electric vehicles, printed circuit boards, medical equipment, military electronics, all of it consumes silver, and none of it gets recycled in any meaningful volume. And here's the detail that most people miss. Approximately 70% of the world's silver is produced as a byproduct of zinc, lead, copper, and gold mining. That means silver output is not primarily controlled by silver prices. You cannot simply build more silver mines because the price is high. Silver comes out of the ground when base metal miners decide to dig. So even with prices at record highs, analysts broadly agree that a meaningful supply response is unlikely before 2028 at the earliest. Now let's talk about what January actually was, because the mainstream framing was misleading. The story told in financial media was roughly this: a speculative bubble inflated by Chinese retail traders who piled into silver futures drove the price to absurd levels and then got liquidated when the margin calls hit. U.S. Treasury Secretary Scott Bessent said publicly that the extreme swings were driven by speculative activity, particularly from Chinese traders. That framing is partially accurate. There was speculation. There was a bubble component. But that explanation is incomplete in a way that really matters for understanding where we go from here. Because the same week prices were crashing, the physical delivery data coming out of COMEX told a completely different story. Between early and mid-January 2026, traders withdrew 33.45 million ounces of silver from COMEX warehouses in just 7 days. That was 26% of the entire registered inventory disappearing in a single week. Think about what that means. Registered inventory is not just silver sitting in a vault. It is specifically silver that has been cleared and warranted for delivery against futures contracts. It is the physical backing of the paper market. When registered inventory drops by 26% in 7 days, that is not people taking profits. That is people pulling physical metal out of the system because they do not trust that it will be there later. And on January 7th specifically, JP Morgan issued 99% of all delivery notices filed that day, 8.1 million ounces across 1,624 contracts in a single session. Let that sink in. One institution, in 1 day, stood for physical delivery on 8.1 million ounces, while the rest of the market was still treating silver as a paper trade. As of early February 2026, COMEX registered silver inventory stands at approximately 103 to 113 million ounces, according to exchange warehouse reports. That sounds like a lot until you look at the March contract. The March silver futures contract currently represents approximately 528 million ounces of notional exposure across roughly 105,000 open contracts. That is more than 4 times the entire registered deliverable supply in a single contract month. Now, most of those contracts will roll or close before delivery month. Historically, only around 10 to 25% of open interest stands for actual physical delivery. But 25% of 528 million ounces is 132 million ounces, and there are only 103 to 113 million ounces officially available. Some analysts examining the data more closely estimate that effective unencumbered inventory, metal that is truly free and available without creating downstream obligations, is significantly lower than even the headline registered figure. That means March is a delivery month where the numbers only barely work under optimistic assumptions, and they do not work at all under stress conditions. This is where the lease rate story becomes critical. Silver leasing works like this. A central bank or large institution that holds physical silver can lend it out to a bullion bank for a fee, the way you might lend money and earn interest. The borrower takes that physical silver, sells it into the market to raise cash, and commits to returning it later. Under normal conditions, when silver is plentiful, the 1-month lease rate for silver hovers somewhere between 0.3% and 0.5% annualized. That is cheap. That reflects a market where physical metal is easy to find. By January 2026, that same 1-month lease rate had exploded to approximately 8%. For context, that is a 16 to 26 times increase over the normal baseline. In October 2025, during the first major squeeze event, 1-month lease rates in London hit 34.9%, with intraday peaks briefly touching 39.2%, according to Japan Bullion Market Association data. Overnight borrowing costs at that time spiked beyond 100% before settling back down. Think about what it means when someone is willing to pay 8% annualized simply to borrow silver for 30 days. It means that the alternative, not having the silver, is worse than paying that premium. It means the physical market is genuinely short of metal. The geography of this matters enormously. London, which operates through the LBMA, is the world's primary over-the-counter physical silver market. LBMA vaults in London have declined by approximately 31% since April 2020, falling from 35,667 tons to around 24,581 tons by September 2025. That drawdown happened across 5 years while demand was accelerating. Meanwhile, the Shanghai Futures Exchange has seen its own vault inventories fall to multi-month lows, with significant withdrawals reflecting an accelerating shift toward private and long-term storage in China. Shanghai physical silver was trading at premiums of $3 to $8 per ounce over COMEX futures prices for extended periods. Under normal market conditions, that kind of geographic price gap would be arbitraged away almost immediately. Traders would buy cheap silver in New York, ship it to Shanghai, and pocket the difference. The reason that arbitrage was not happening is because China had tightened controls on refined silver exports, reclassifying the metal as a strategic resource. If physical silver cannot move freely between markets, regional price gaps can persist indefinitely. And when arbitrage breaks down in a commodity market, it is usually a signal that something structural is broken. Let's be precise about the paper versus physical distinction, because it is the key to understanding why a price crash and a physical shortage can coexist. When you buy a silver futures contract on COMEX, you do not own silver. You own a contract that says you have the right to take delivery of silver at a future date under specific conditions. The vast majority of futures market participants, hedge funds, commodity traders, banks, have zero intention of ever taking physical delivery. They are trading the price of silver, not silver itself. This works fine as long as there is enough physical metal in the system to satisfy the small percentage of contracts that do seek delivery. The paper market can be many times the size of the physical market and function normally. But when the ratio of paper claims to deliverable physical metal gets too extreme, you start getting the warning signals we are seeing now. Backwardation in the futures curve, where near-term delivery prices are higher than future delivery prices. Exploding lease rates. Regional price premiums that cannot be arbitraged away. And unusual delivery activity from major institutions pulling metal out of vaults early. Backwardation is particularly telling. In a normal, healthy commodities market, future prices are higher than spot prices. You pay more for silver delivered in 6 months than silver delivered today because of storage costs and financing. When that relationship inverts, when today's silver costs more than silver delivered in the future, it means the market is signaling that physical metal in your hand right now is genuinely more valuable than a promise of metal later. That is not how a market behaves when supply is comfortable. Now let's look at where the demand is coming from and why it has been so persistent. The structural demand story for silver has 2 distinct components that reinforce each other. The first is industrial. Solar photovoltaic manufacturing is the single biggest growth driver, consuming 232 million ounces in 2024 alone. That number is forecast to continue growing as governments around the world accelerate renewable energy build-out. The electrification of transport, the expansion of AI data center infrastructure, the proliferation of electronic devices in emerging markets, all of these are silver intensive. New research published in January 2026 in the journal Nature Materials showed that a nanoscale silver coating, just 3 nanometers thick, can solve the cracking problem that has plagued solid-state battery technology, making silver-treated solid electrolytes 5 times more resistant to lithium intrusion damage. If solid-state batteries reach commercial scale, and the research trajectories suggest they will, silver demand from that sector alone could add tens of millions of ounces of annual consumption that simply did not exist in previous forecasting models. The second demand component is financial and monetary. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, compressed from approximately 100 to 1 in April 2025 down to around 45 to 1 at silver's January peak. That compression represents one of the most dramatic precious metals realignments in modern market history and reflects a genuine re-rating of silver's monetary value by institutional investors. Sprott Physical Silver Trust, one of the largest physically backed silver investment vehicles in the world, announced on January 20th, 2026, that it had doubled its at-the-market equity program from $1 billion to $2 billion, with all proceeds designated for purchasing physical silver bullion. At prevailing prices around $110 per ounce at that time, $2 billion buys approximately 18 million ounces, roughly 16% of the entire COMEX registered inventory. That is not a speculative trade. That is a major institution making a long-term structural bet and signaling it publicly. Meanwhile, on the other side of the ledger, the short side of the silver futures market has been under extreme stress. In October 2025, during the first squeeze event, data from the CME Group showed open interest in COMEX silver futures fell by more than 22% between August and October, as short traders were forced to unwind positions they could no longer sustain. In India, the stress was even more visible. 44 trading firms in Rajkot declared insolvency after being caught short in the silver market and unable to cover at prevailing prices. When businesses are going bankrupt because they sold silver they did not have and could not buy it back, that is not a speculative froth story. That is a genuine supply crisis playing out in real time through the financial system. The question that matters now, in late February 2026, with silver sitting around $87 to $90, is what happens next. The honest answer is that there are 2 plausible paths, and the difference between them depends almost entirely on whether the March COMEX delivery month resolves cleanly or not. The bearish case is straightforward. The January crash purged a significant amount of speculative leverage from the system, Chinese retail participation has decreased, and the price normalization continues toward the $70 to $80 range as the most aggressive paper longs exit. In that scenario, lease rates gradually normalize, the March delivery month is managed through inventory conversions and rolling of contracts, and the market stabilizes in a new trading range that is still dramatically higher than where silver was a year ago, but well below January's peak. That is the scenario that Treasury Secretary Besant and mainstream financial media are implicitly describing. The bullish structural case is more complicated, but arguably better supported by the underlying data. In that scenario, the January crash was what analysts are calling a symptoms treatment, not a structural fix. The 528 million ounces of notional exposure in the March contract against 103 to 113 million ounces of registered physical inventory has not changed. The lease rates have declined from their October and January peaks, but remain at 6 to 8% annualized, still 12 to 26 times the historical normal level. The LBMA and COMEX vault drawdowns have not reversed. China's export restrictions on refined silver remain in place. The 5th consecutive annual supply deficit has not been resolved. Industrial demand from solar, EVs, and emerging solid-state battery applications continues to grow. In this scenario, March becomes the event that forces a repricing, either through exchange rule changes, cash settlement substitutions, or actual delivery stress that becomes publicly visible. If that happens, the price move back toward and potentially through January's highs would be rapid, because the structural buyers who pulled physical metal out of vaults in January are not selling it back at $90. The historical precedent that is worth understanding here is 1979 to 1980. In that period, a genuine physical squeeze, combined with financial speculation from the Hunt brothers, who accumulated an enormous long position in silver, drove prices from around $6 per ounce in early 1979 to $50 per ounce by January 1980, a gain of over 700% in roughly 12 months. The resolution was ugly. COMEX changed its trading rules in January 1980 to restrict new long positions, forcing large speculators to liquidate, and silver crashed back to $11 by the end of March 1980. What is different today is that the demand is not primarily speculative. The industrial demand is structural, The financial demand is spread across thousands of institutions and retail investors globally, rather than concentrated in a few large positions, and the supply deficit predates the price surge by several years. That does not mean the same kind of regulatory intervention cannot happen again. Exchanges do have the authority to change rules, raise margins, or restrict trading in ways that can override the physical fundamentals in the short term. What it means is that the structural pressure underneath the market does not go away just because the price is corrected. For someone who already holds physical silver, the current situation calls for clarity about what you own and why you own it. Physical silver purchased and held outside of the financial system is not subject to counterparty risk. You are not exposed to COMEX delivery mechanics. You are not exposed to bank solvency issues or lease rate spirals. What you are exposed to is price volatility, and the move from $121 down to $87 has been genuinely uncomfortable. But the structural case for silver, the supply deficits, the industrial demand growth, the monetary rereading, has not weakened because the paper price corrected. If anything, the correction has clarified who holds metal for genuine long-term reasons and who is simply riding the momentum. For someone who has been waiting on the sidelines watching this, the correction window is real, but comes with genuine uncertainty about timing. The March delivery month is the near-term catalyst that could resolve either way. If it resolves without visible stress, prices could continue consolidating in the $80 to $90 range for weeks or months before the next structural move. If it does not resolve cleanly, the move back toward triple digits could happen quickly and with very little warning. Sizing positions appropriately and understanding that volatility in either direction remains elevated is the honest framework here. For someone who wants to track this market in real time, the specific data points worth watching are COMEX registered inventory, available daily through the CME Group website, and 1-month silver lease rates, which are published by the LBMA and the Japan Bullion Market Association. If registered inventory continues declining and lease rates push back above 10%, those are the early warning signals that March stress is building. If inventory stabilizes and lease rates compress back toward 2 to 3%, that is the signal that the physical market is finding equilibrium and the bear case is playing out. Shanghai physical premiums over COMEX, which you can track through the Shanghai Futures Exchange and Bloomberg commodity data, are the third data point worth watching. A premium of $3 or more persisting over multiple weeks means Asian physical demand is still outrunning supply chain capacity to deliver. What makes this market cycle genuinely unusual in historical context is the convergence of three forces that do not typically coincide. Structural industrial demand that is non-discretionary and growing, a monetary demand wave driven by institutional re-rating of precious metals as dollar alternatives, and a physical supply infrastructure, from mines to refiners to exchange vaults, that was built for a world where silver was a $25 to $30 commodity and is now operating under the strain of a $90 commodity with accelerating demand and no rapid supply response possible. That convergence does not resolve in a month. The question is not whether it resolves, but how and over what time frame. If you want to verify any of the data in this video, the primary sources are the CME Group COMEX warehouse reports, published daily at cmegroup.com, the LBMA vault data, published monthly at lbma.org.uk, the Silver Institute's annual World Silver Survey, available at silverinstitute.org, and the Sprott PSLV prospectus updates, filed with the SEC. All of these are publicly available and free. Do not rely on anyone's interpretation, including this one, without checking the primary data yourself. The numbers tell the story clearly enough without any embellishment.